Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky, and I have Chris Martenson on the line. He's an economic researcher and futurist. Chris, how you doing this morning?
Hey, I'm doing great, Joel.
All right. Could you just give us a little bit of your background on what kind of economic research you focus on and why you call yourself a futurist?
Well, I'm a scientist by training, so I love data and spent a lot of time in corporate America too. So I like numbers. I put a lot of numbers together, and a futurist is a term that really pops out when you just extrapolate trends. You know, it's some people call it a futurist, but it's not. What I'm doing is really just stating the obvious, really, by saying, look, if you have more retirees and people paying in and you've got an unfunded pension entitlement program, you have trouble coming down the line. So I look at the larger trends, and the biggest one that concerns me the most is watching what's happening in energy.
Okay, and that's where I want to go to with this. We did an entire show on Friday discussing, the outlook for the crude oil market and for stocks, different sectors, exploration, and also, your integrated oils. And I think it's fair to say, Brianna, that we kind of had a bearish stance on crude here at $50, and that they saw more factors for it declining than to getting a big rally. And the back of my head, I actually mentioned this to Brianna last week, that I remember you were talking about the different methods of drilling, the fracking, and that was providing a lot of shorter term supply, but you weren't sure how long those resources were going to be available. Could you just touch on that for us?
Absolutely. So one of the things we know about the shale plays is that they came on explosively, delivered a whole lot of supply very, very rapidly, increasing 3-4 million barrels a day on U.S. supply is a big deal. It takes probably a decade or more, maybe 15 years, to take a conventional oil field, get it to ramp up to even 1 million barrels a day of output. But, these shale plays came on like gangbusters. They're going to go away like gangbusters, too. They are a real flash-in-the-pan resource. You drill, you put a hole in the ground in the Bakken, you go down 10,000 feet, you tip the drill bit sideways, you go sideways 10,000 feet, you do a 25-stage frac, hugely expensive, $9 million a hole. And it comes on, but it only puts out maybe 400 barrels per day on average for the first month. Within 3 years, you've lost 85% of that output. So the shale plays are really all about, can you just keep drilling holes? Well, we've pretty much slowed that down at this point. If oil stays under 50 much longer, we'll pretty much stop, because there's no hole you can drill that's that expensive and really make money at it for long. So these companies now, they're bleeding, they're hemorrhaging, they're all crossing their fingers hoping the price of oil comes back up. If it doesn't, we'll see the supply drop off really rapidly.
Okay, so where's the break-even point for some of these companies, and what are some of the companies that you're referring to that have cast their lot with the fracking and the shale oil plays?
Well, this is interesting. One of the things you like to see in a healthy company, any industry, is positive free cash flows, which is the difference between operating earnings after you take out what they have to invest in their capital. So take CapEx, subtract that from op earnings. Hopefully you've got a positive number. All 80 of the shale operators that I track had negative free cash flows from 2008, 9, 10, 11, 12, and 13, probably 14 when I add it up. So what do you think of an industry that is, when it's in the midst of doing what it does, is cranking out, making as many holes in the ground as it can? Even during the years when oil was 100 a barrel, they were still in negative free cash flow territory. That bothered me a lot.
That bothers the heck out of me too. And could you you file 80 companies. Could you start with some of the big boys so we could pull up a chart of those and see how they've been reacting?
Sure, you could look at Devon, Petrohawk, Chesapeake, Occidental, any of those. Although Oxy's just a little bit more diversified than some of the other ones. Not a pure shale play on that company. And take a look at their free cash flows, and you're going to quickly discover that they're $1, $2, $3 billion per quarter in the hole, depending on the size of the company. And that was with oil at a much higher price. So what I'm looking at when you've heard a lot of spin out there. There's been a lot of analysts, particularly on the sell side, saying, hey, these companies, they make money at 50. No, they make money at 40. They make money at 70. you have to be careful of what they're actually measuring. I'm looking at the all-in cost of production. This is the self-sustaining, because you can't just drill the hole and say, how much did I get for the oil? The directors of the company need to be paid. The debt interest service payments need to be made. You have to look at all the actual ins and outs and the cash flows of the company to understand where they are. And my break-even, when I look at it this way, is probably closer to $75, $80 a barrel. You've got companies that are starting to break even at that level. At 50, I don't know anybody who's really making money.
All right, so you mentioned Devon Industry, and then what was the symbol for Mohawk? Is that MHK? But that was another Mohawk that we were. No, that's a different one. What was the third symbol you mentioned?
Go ahead and look up CLR.
Okay.
That's Continental.
Okay, let's just take a look. Oh, boy, okay. And getting a little bounce, the stock has been cut in half. So you said that it takes 10 years, basically, to deplete these. So, I mean, if you're trying to buy crude here and you're basing it on this oversupply in the market, might you be a little bit early here?
You might be a little early. So right now, the United States, in all of our storage tanks, Cushing being the largest one, we have a level of oil in storage right now that's higher than it's been at any point in the last 80 years. So we've got just a huge amount of oil in storage. A lot of that is because traders are starting to take advantage of the contango that's built into the futures market. You can sell a barrel of oil a year from now for about $10 more than it costs you to buy it today. So people are selling oil a year out and then buying an equivalent amount of oil and parking it in tanks. They've got a free $10 a barrel sitting there waiting for them. If they can get it stored for less than 10, they're making money. So we're seeing a lot of storage because of the price structure that's in the futures market, and that's driving some of the amount of oil that we're seeing in storage. But here's the big story. I think it's still early. We're still, there's a chance of oil going lower in price because of structural oversupply right now. But you look at the price of oil, demand is clearly going up. The United States is consuming a little over 5% more this year than we were last year, so demand is responding. And as the drill programs slow down, we're going to see less supply coming out of the ground. So, typical fundamental argument. Demand going up in response to price. Supply is going to go down faster than most people expect because you can turn the shale plays off like a switch, just like you turned them on. I'm looking at third, fourth quarter of 2015 for a possible price shock because of these factors.
Okay, I like that. You're putting some timing on your calls. I respect that quite a bit. Before we let you go, can we just talk about some of the bigger companies? Your ExxonMobil, your Chevrons. They went down, with the early part of the decline in oil, but seem to be holding up fairly well. Could you give us a take on those two issues?
I am exceedingly bearish on the big integrated oil companies right now. They've, again, last year, absolutely failed to come up with new discoveries. It was the worst year in decades for oil discoveries. This was with one of the highest levels of CapEx expenditure ever. So they're spending more, finding less. They're discovering it's just getting harder and harder to replace reserves. So that is the lifeblood of these companies. They either replace reserves or they don't. That's the piggy bank in this story. They just had a miserable 2014, and of course now they're slashing their capital expenditure budgets hugely. And so I'm expecting 2015 is going to be an even worse story in terms of discovery and reserve replacement for these major companies. They're having a really hard time. I like the mids, the small companies, the nimbler ones, the ones who can take advantage of the shale plays, particularly the ones who can nimbly step in, step out, control their CapEx. Those are going to be the ones I think to watch going forward. The big companies are just having, last year was just a miserable performance.
And could you give us examples of some of those mid-sized companies that you'd be keeping an eye on?
Well, we mentioned a couple of them. I'm looking at Continental Resources here. We're going to be taking a good hard look at anybody who's pretty well just diversified into North American shale plays at this point in time. I haven't seen anybody have any success yet outside of the United States for geologic reasons, geopolitical reasons, things like that. So the symbols on the ones I'm really keeping track of here for those mid-size DVN, that's your Devon. You got EOG, Range Resources as well. Chesapeake, not as much Chesapeake. They're having a little trouble, but Continental. So those are the big mids in this story, and I think they're all going to do well once we're done with the bloodletting. I don't think that's over yet.
What about REG, Transocean Limited? No.
No, we have huge trouble there. So it was February a year ago. We saw all the major companies cutting their capital expenditure budgets. This was when Brent oil was at 110 a barrel. Where they were cutting was the most expensive things, which is deep water, ultra deep water. Those are the rigs that you're seeing getting cut in those companies you mentioned. And we're not going to see any activity in those plays until we see Brent oil over 110. My guess is 120, 130.
Oh, wow. That's quite a ways away from here. And just oil storage. We get a question out of the chat here. Is there a tipple? I don't think there's a ticker symbol for oil storage, but how do you follow it?
I follow it at the Energy Information Agency, the EIA. They do a weekly oil inventory report, very easy to find, and they do a great job summarizing that. World storage is a little bit trickier to find, but the International Energy Agency, the IAE, does a reasonable job reporting on that, although it's a little bit trickier. And then, of course, you're just going to have to start following some of the news reports, because the biggest form of international oil storage coming online right now are the very large crude carriers, the VLCCs, that are being loaded and parked. And again, that's people taking advantage of the oil storage contango story.
Okay, and you touched on a lot of different things here. Just any, final words of advice? I mean, I know you're given a pretty good time horizon on this. Can for people that are looking at the USO or trying crude oil or crude oil futures, what's the best way to play a potential rally in the oil patch?
Well, the easiest thing to do is just to play the stocks and hope that you've picked a good company. This is the time to start doing your fundamental analysis. Really watch which companies hedged well, which companies manage their cash flows well, who can manage their debt levels at this point. There's going to be some consolidation, which is a fancy way of saying there's also going to be some bankruptcies and wipeouts. A lot of very highly leveraged companies in the shale play. So just, take a look at who's going to do well. I think that's a great way to play it. I am looking for a pretty strong rally in the oil price going forward, but not yet.
Okay, all right. Well, we'll keep an eye on it. I like the way you you quantify your calls, and that's the way to go in the markets. Risk reward always works. Chris Martenson, he's an economic researcher focusing on the depletion of our oil resources. Chris, thanks for coming on. We hope to talk to you again soon.
Joel, it's been my pleasure.